guys, Akil Stokes here. Welcome back to another video edition of the Trading Coach Podcast. If you've been following me for any time now, you know that one thing I'm really big on is backtesting. And if you're newer and not quite sure what backtesting means, it simply means the testing process where we want to take our trading strategy or trading ideas through historical data and figure out if our approach actually has an edge, meaning that does it create profit or not, or figure out what may need to be added or adjusted in order to reveal this edge. Sounds great, right? And trust me, it is. But here's the thing. Just because you backtest something doesn't necessarily mean that it's automatically going to work. And the harsh truth, I guess, is that the backtesting process is a very long, it could be a tedious, it could be a frustrating process. And many times you will go through that entire process only to find out that something, in fact, doesn't work. And although it seems like a waste of time in present day, trust me when I say that the lessons that you've learned from that process, not just developing your RAS, so your ability to read price action, but learning the things that do work that could be used for the future, or the things that didn't work that should be taken out of the future, will be very helpful. And this is a conversation I was recently having with one of our tier 1 trading members as they're going through the backtesting process. They went through it initially. They made kind of a small mistake, but a major mistake that caused a big shift in their profitability. And after fixing that mistake, they discovered that, hey, what I thought was extremely profitable is not as profitable as I thought. And the trader hit me with a bunch of questions. One about, should I keep trading? Should I keep testing and see this thing through? Or should I dump it? And if I am going to continue to test, should I try these different type of filters? And when answering it this morning, I thought it would be an excellent opportunity to share this advice with you guys out there as well, since many of you are either in the same situation as this trader currently, or will eventually be going through it. So just to name a few of the topics we're going to discuss today, because I'm not going to go through every single detail because it's specific to the strategy, but we are going to talk about front-running orders. We are going to talk about avoiding false assumptions. We are going to talk about picking the best trading sessions to trade during, and ultimately, and this is the most important one, having the proper expectations and how to grow your trading like a business. So let's get started with reading the email. Of course, I'm unprepared, so I don't have it up. So I will edit the portion where I'm looking for it out and come straight to you with the email. So I'm going to read the full email to you, and just remember that we're not going to go into all the details of every single question when I give my answer because it's very strategy specific and some of you can care less about it. But I am going to pick a few of the subjects that I think are going to be universally important. So it says, hey Akil, I've been testing the cipher pattern on the 4-hour time frame and realized that I made a small but huge mistake by not filling in my stop loss on both targets. And pretty much what our trader was doing was this. We've got a money management spreadsheet, a backtesting spreadsheet where you fill out all your information. And if you're trading multiple units, like multiple contracts, meaning you're going to take like a target 1 and a target 2, we have different columns for that. Now, if you are doing such tasks, when you win, you need to fill out your exit price for target 1, which is your target 1 profit, and your exit price for target 2, which is your target 2 profit, and that combines to give you your total profitability. However, what many traders forget to do, and why it ends up being a big mistake, is that when they get stopped out, they only fill out the stop loss for a single target, which really means half of their position. So essentially what that does is it means that when they win trades, they're tracking their wins as full wins, but when they lose trades, they're tracking their losses as only half losses. And I think this trader made a mistake with the secondary targets as well, but commonly we see this with the secondary stop loss. So when you go back and fix that mistake, you can obviously imagine that all of your losses are going to increase, which is going to have a massive effect on your trading results. The trader goes on to say, I've tested 8 pairs so far, all major pairs, and after correcting this mistake, the result turned out to be very poor. For example, Euro dollar only shows an 18% return over a 10-year period. My rules are the same as in the course material, except for a few adjustments. When price moves in the opposite direction, I adjust targets 1 and target 2s with fib retracements to where the candle body is instead of the wick. My anchor leg is chosen similar to how Enigma does, which is our pattern recognition software. Many anchor legs in Enigma are not ideal, but I wanted to test the same way for consistency. I trade it with absolutely no tolerance, zooming in closely to make sure everything is hit correctly. On many occasions, right, Enigma showed big profits while my decompletion didn't hit, often missing by 1 or 2 pips. I was under the impression that harmonic patterns should be traded in a very black and white manner, which is why I chose the cipher pattern to begin with. So here are my questions. Again, we'll go through these later one by one. Should I continue testing the remaining 21 pairs even though my results are likely to be poor, or should I start tweaking now and retest a couple major pairs first? I'm considering these adjustments: eliminate weak anchor legs, follow the overall trend direction on the daily time frame, allow some tolerance to my fib ratio 1 to 3%, use wicks instead of candle for body targets, avoid trading during the Asian session. I'd appreciate your guidance. And then the trader goes on to talk about how he's really focused on trading. He's locked in. He's very data oriented, but sometimes also gets overwhelmed by the amount of data that he's collecting. And he values his ability to think in probabilities and problem solve and stuff like that. And then lastly, just because it makes us sound good, lastly, I want to thank you and everyone at Tier 1 Trading. You guys have completely changed my life for the better, and you're doing an awesome job. Have a wonderful day. Insert Tier 1 Trading thing at the bottom of this video sharing the 14-day trial membership. Right? So anyway, let's go back and talk about some of these topics. And I want to start off with the first one. And one of the first statements that I saw that popped out to me was, my rules are the same as in the course material, except for a few adjustments. So when you say except for a few adjustments, it means that they're not exactly as they're taught in the course material. Now, I'm not saying this is a negative. If you guys know my teaching philosophy and Jason's teaching philosophy, you should make things your own. Meaning that you should develop or find or develop a style of trading and then, find a way that it meets your personality and your philosophy. Find the things that you value, find the time periods that you can trade it in, add your kind of, your special sauce and your seasoning to the trading to make it your own. Because when you trade something that personally reflects you, you're less likely to make mistakes. And in general, when you make less mistakes, you keep more of your profits. With that being said, a big flaw that I see many traders make, and again, I'm not saying in this specific scenario, but in general, is that traders will be given a strategy that is profitable. We've had this discussion many times about how it is typically the trader and not the strategy. Traders will be given a strategy that is profitable, but instead of trading it the profitable way, they will add something to try to make it better, in many cases without testing it to ensure that they made it better. And then it actually makes the strategy worse, and they end up complaining and losing and blaming the strategy instead of themselves. So here's my opinion on it. So I'm all for traders tweaking and filtering their strategy to make it their own. Again, I believe in that 100%. But here's my opinion. My advice for you guys when you go into the testing process is to start off by doing what's called a baseline test. And what a baseline test means is that you're taking the strategy as is, you're not changing anything, you're testing it and you're acquiring a baseline set of data. And what that baseline set of data is going to allow you to do is it's going to allow you to make future comparisons. That way, when you tweak this and you change that, or you add this or you add that, now you can compare it to that baseline result and see if your adjustments are actually making the strategy better or worse. Again, a lot of the times in our mind, we assume that, hey, by doing this, it's going to have better results, and it actually has negative results, but we can't really tell because we don't have anything to compare it to. So do that baseline test first and foremost. That way you have something to compare it to later. Now, again, there's a lot of subjects I want to dig into, but I want to make this as general as possible because I know everyone trades differently. But another sentence that I want to touch on is this one. The trader says, on many occasions, Enigma shows big profits while my decompletion didn't hit, often missing by 1 or 2 pips. And this means that in pattern trading, there's a very specific price point in which you're looking for the completion. They're saying that in many cases, price comes like right to that point, doesn't hit it, and then turns around and reverses. And it's like, oh man, that would have been a big win, but I just missed it. This is where, and the solution I have for this is simple. This is where something called front running comes into play. And I don't mean front running by the legal way that you've heard in maybe some of these books, the high frequency trading way, where we have this super fast internet connection that does illegal things. But what I mean by front running is instead of placing your order at the price point that you believe price should complete at, you're getting it a little bit beforehand. So you're giving yourself a little bit of buffer zone. And there's many reasons for this. There is taking the spread into account. If you guys have ever traded live, you know that price action you're not going to get filled if price action hits your price point. It has to go through that price point by the spread before you get filled. That way the broker gets there. So many of times you may see on a chart that price actually hits the exact point, but in real life you would not be filled. There's also the thing that there's no common data center for forex trading specifically. So depending on your data provider, the quotes are going to be a little bit different. So it's never a bad idea to have that buffer zone. But if you find yourself in a situation where you're just missing by a little bit on a consistent basis and you want to do something about it, front running is an excellent solution for that. You can front run by as little or as much as you want. If I can get words out right, you can front run just on entries. You can front run on just on targets. You can front run on, or back run, I guess, on stops. You can do all three. That's completely up to you. I personally do it in my trading. I think it's a good idea because, again, I've seen so many close enough patterns that it really bothers me not to get involved. So I want to give myself the best opportunity to be involved in the trade. I'm not looking for the perfect entry. I want to be involved in the move. Now, there is the downside, right? Whenever you front run, you're going to enter a little bit early. If you're front running targets, you're going to exit a little bit early. So it is going to take a little bit away from your profitability. It is going to change your risk profile a little bit. But what you have to determine, right, and be comfortable with, and you can tell this during testing as well, is the sacrifice of getting a little bit more getting a little bit less when I win or losing a little bit more when I lose, is that worth the sacrifice of, hey, I'm going to be involved in blank more winning trades, and the profit that I would make from those trades that I would otherwise just miss is going to make up for the little bit that I'm lacking on smaller reward or bigger risk. So definitely something to consider. And again, this is easily something that you can do in your secondary testing and compare it to your baseline. And we'll talk a lot more about that later. The next statement is, should I continue testing the remaining 21 pairs even though the results are likely to be poor? Or should I start tweaking now and retest a couple of the major pairs? And 2 points I want to cover with this one. One, why are we assuming that the results are likely to be poor? Right? Just because we had a poor result on one pair A, doesn't mean that results are going to be poor on pair B. Just because our trading strategy doesn't work in this market doesn't mean it will work in that market, right? Trading strategies are unique. And, in this case of advanced pattern formations, an advanced pattern formation typically forms in a period of consolidation. So the pairs that consolidate more are going to give you more opportunity to trade and probably a higher hit rate than, or a winning hit rate than the ones that are more directional, right? So if you are trading a pair that is very directional and you have poor results, and then your next test is a pair on a pair that is very consolidative, you may have great results on that one because it just fits the mold of what your strategy is looking to do. This is the same thing, for trend traders, right? If you are a directional trader, pairs that are in consolidation for 80% of the time are going to tear you up and rip you to shreds. On the other hand, pairs that have a nice flow to it, right? You're going to be making bank on those. So we can't assume that just because one pair didn't perform well that the other pair won't. This is why we want to give an honest, non-biased kind of approach to all the pairs that we test or plan on testing, and then let the numbers make our opinion for us. The second one is that don't assume that the major pairs are the most or the best performing pairs. And I know I do the same thing, right? When I test, I always start off with the majors. We always go to, what's our first one? Euro dollar. We go to pound dollar. We go to dollar yens, right? We go to these major pairs because they are the most popular, and we assume that because they are the most popular, they are going to work the best. That's actually not the truth. So in my experience of how I trade, right? The euro dollar, it's not a bad pair by any means. It makes money, but it's middle of the pack. It does its job. It doesn't really wow me. I wouldn't trade it by itself. It makes me money, but it doesn't really, stand out. But it's by far the most popular pair in the forex market, right? So I would encourage you to test different types of pairs. Now, yes, if there's a pair that has like a really big spread and you wouldn't trade it in real life because of that spread, stay away from it. If there's a pair that you personally detest, like the Swiss for me, I don't trade Swiss pairs because I personally detest them, right? But test all the ones in between. Test the minors. Typically the minors tend to have a more natural movement to them because they're not as institutionally influenced, such as like the euro dollar, the pound dollars, the dollar yen and stuff like that. So there may actually be like less whipsaw and less kind of funky movement on those pairs because the big boys just don't care about them as much because they know retail traders don't care about them as much. But give everything a fair opportunity is what my advice would be. Now, one more of the common questions I wanted to handle was, it said something that this trader is considering testing is avoid trading during the Asia session. And seasonality seasonality, timeouty, I don't know how you would call it, sessionality, I guess, is important, right? Obviously, depending on what type of trader you are. If you are a swing trader, you're probably going to take pairs across the clock. I don't think you're going to be able to filter a certain session out. For example, if I'm a trader that trades on the 4-hour time frame, even the hourly, to be honest with you, understand that the frequency specifically of advanced pattern formations isn't that much, right? As a 4-hour trader on a single pair, I may get 2 of a single pattern setup per month. If I get 2 ciphers a month, that's probably a big deal. So if one happens to form in the Asia session and I eliminate it, I don't take it, all of a sudden I am slashing my frequency massively, and that's going to have a major effect on our overall results. So if you are a swing trader, you want to be careful and see how much sessionality actually matters. I think it's going to matter a lot less than you assume. But don't take my word for it. There's an easy way to do it, right? Again, have your baseline tests, right? When you're done your baseline tests, filter out all the opportunities that were entered during the quote-unquote Asia session. Take those out of the equation and see if it makes a difference, right? You'll see one of 3 things. Either 1, taking them out makes your performance go up, good, right? 2, taking them out makes your performance go down, bad. Or 3, it has no effect at all. But it's an easy thing to filter out if you're properly doing the backtesting and keeping track of time and date. Now, if you are more of a day trader, then yeah, I think this is going to have a much bigger effect. You're going to have a lot more frequency with your trades. Sessionality, right, is the new word of the day, right, is going to play a bigger role in your trading. And honestly, if you're day trading, you probably don't plan on, it depends on where you're at, I guess, but you probably don't plan on being up 24/7. So you're isolating a specific time period to trade. So you do the same thing as going through your charts and kind of breaking up the sessions, but seeing if there are time periods that stand out amongst others. I remember when I first started trading, I traded this mechanical system. I think it was called the SOS, right? And I broke it up. I was a full-time trader because you guys know my story. I quit 3 jobs to trade full-time and chase my dream only to fall off a cliff chasing it, but then catch myself at the very bottom and climb my way back up to success, right? Great story, right? Not at the time, very horrible and depressing at the time, but almost 20 years later, we can laugh at it and cry only a little bit. But anyway, I was trading this system called SOS, which was a mechanical system, and I tested it 24/7 because in my mind, I was like, hey, whatever it takes, if I got to stay up 24/7, I'm going to stay up 24/7. Another lesson I learned, right? We need sleep to be sharp in trading. If we're not sharp in trading, results get bad. So don't try to be the 24/7 trader, but you do dumb things when you're young, right? Anyway, I remember setting myself up where I only looked at the optimal times to trade. So I would trade the system from like 6 o'clock in the morning to like 10 o'clock in the morning, right? 6 a.m. to 10 a.m. New York time. And then I would take a break from like 10 or maybe 11 o'clock. And then from 11 to like 2, I wouldn't trade at all because nothing would ever happen. My results showed me that there was no activity or not enough activity during that session. But I would come back and trade it from like 2 to 4, and I would trade it at night for some time as well. So again, it didn't last that long because I burnt myself out, but I was able to, or I attempted to maximize my performance by eliminating the times that the strategy wasn't at its best and only trading the most efficient and effective times for that strategy. So the final lesson or lessons, right, put the S inside the thing that I want to share with you guys is this. During your back testing, you don't want to start back testing until you have an idea of what you want to filter, right? So we talk about doing the baseline test, but even before that, you should do something called pre-back testing. And pre-back testing is the phase where you're just developing your eyes to see the thing you're trading signal, but you're also looking for little clues in the market, because what you're trying to do is you're trying to brainstorm to see what should I test as I get into my testing phase. Because there's nothing worse than doing a whole testing phase and then being like, oh, I should test that, then going back and doing a whole nother testing phase and being like, I should test that, then going back and doing it again. Yours truly did that and took me a very, very long time. So if you can do it in that pre-back testing phase where you're training your eyes, but also jotting down, look for this type of anchor leg, look for this, do I front run, yes or no? Now at least you have an idea of like, hey, when I test, I'm gonna test everything at once. And it will take a long time, right? Because you'll be testing different scenarios for each signal, and you'll probably have to create a custom Excel spreadsheet. That way you can have different tabs or columns for each of the things that you're testing. But in the long run, it's going to be a lot easier because you're not going to keep going back over and over again. Now, the last lesson that I want to touch on is this, and it has to do with proper expectations and treating your trading like a business. I didn't get a chance to hear back from our trader yet after we've been going back and forth. But in the last email that he sent me in response, he said that, hey, out of all the 8 pairs that I've tested, they all gave similar results, between 16 and 20% return in 10 years of testing. And remember, earlier he said these are failing results. And my question is, are these failing results? And that's only going to be an answer that you can answer as an individual. But 2 things. 1, we have to have proper expectations of what our results should be. And then 2, I'm holding up 3 fingers, sorry. 2, we have to have a proper plan on how to develop those expectations, bigger picture. And what I mean is this, right? So we had 8 pairs that made between 16 and 20%. So let's say 18% over a 10-year period. You take that and you multiply that by 8 pairs and you divide that by 10. That's going to be about what, 14% a year, something like that, 14 point something percent a year. So his strategy, and again, I don't even know what the risk is, right? So the risk can be 0.5%. He could be risking a lot. I don't know that part. There's no money management into this to elevate those stats either. This is just kind of bare bones at whatever a trader has. But the question is 14% a year enough for you? Well, it's profitable, yes, but you can make 14% in the market by doing a lot less work. I can dollar cost average into the S&P and I will make more than 14% a year, and that takes me, a lot less time to do. So I wouldn't personally trade for a 14% return on investment a year, but remember, this could only be a small piece of the puzzle. And what I mean by that is this. Treat your trading like a business. We say that a lot. What does that mean? Well, it means that most businesses just don't offer a one-off product. Most businesses just don't have a single store that sells a single thing. Now, don't get me wrong. I've worked with traders who have traded a single strategy on a single pair on a single time frame and have massive success. So it is doable. I'm not saying it's not. But most traders need to diversify their business or diversify their trading portfolio to have success. And what I mean is this. There's 3 ways you can look at it. 1, you can trade a single strategy on multiple markets. And that's what this trader is doing right here. He's trading one strategy, the cipher pattern, and he's looking at multiple markets. Right now it's 8. He's going to test maybe 20 of them. Who knows what the ending result will be? It all depends on how many is profitable. But he's taking one way of trading and doing it over a lot of different things. 2 is by trading one market, so one pair, one asset, but having multiple different strategies. So let's say I only want to trade the euro dollar. that's the only thing I'm focused on, but I can be a cipher pattern trader, a trend continuation trader, an FTB trader, a daily chore trader. I have multiple ways to attack it, and I can increase my frequency and therefore profitability by doing it that way as well. The third way, which is the best of both worlds, and this is within reason, of course, is you can trade multiple strategies on multiple pairs. So maybe you trade 3, 4, 5 strategies on 10 pairs. Now, you don't want to overwhelm yourself with doing too much, but you can either take, let's say if you're trading patterns, for example, they don't come too frequently. So instead of just trading a cipher on 10 different pairs, how about you trade a cipher and trade a bat and trade a Gartley and trade a butterfly? Now you're trading 4 different types of patterns on these pairs. It's going to increase your frequency and therefore increase your profitability. Again, we take that 14% mark that he averaged per year by just trading the cipher, and let's say those 3 other patterns give you the same results. This is going to be math now. 14, 28, 42, plus the one before that. All of a sudden, you're up into the 50s percent-wise. Again, obviously you may have to dial back your risk a little bit, but the main point is what you've done is you've taken one thing that's profitable, a little bit profitable, that in its own right doesn't stand out. But when you add other things that can be traded with it, right? Now you've got 4 little things that are profitable. I ran out of fingers here, but you get it. Yeah, look at that, 4 fingers, 4 little things that are profitable, and you put them together, and now you've increased your profitability drastically. And that is treating your trading like a business. It's no different than I've been watching a lot of Wall Street Journal episodes, YouTube episodes on fast food restaurants and talking about, for example, beef. Taco Bell was the last one I watched, and Taco Bell is getting into chicken now. They do chicken nuggets, and a lot of people are like, well, Taco Bell, you're supposed to be tacos. What are you doing with chicken nuggets? Well, they're diversifying for many reasons. Obviously, chicken nuggets are a nice finger food. Gen Z loves them because you can kind of pick up and play and eat them on the road and on the go. But chicken prices are also a lot cheaper than beef right now because beef prices have elevated, and it just makes the margins a little bit better there. So again, Taco Bell is not just selling one thing. They are diversifying their menu to ultimately create a greater P&L. One last example I'll give you if the Taco Bell didn't make sense or if you got too hungry and got distracted is the casino analogy, right? So we know that casinos have an edge. If you go into a casino, you're most likely to lose. And casinos do 2 things, right? They have different games you can play. So let's take this as like different strategies, right? They have craps, they have roulette, they have blackjack, right? This would be trend continuation, FTB, cipher pattern, right? Different games are like different strategies. So not only do they have different strategies and games that you can play, which attracts different type of people to the casino. Remember, the casino's job is to get people in the door. But when you go into a casino, is there only one blackjack table? No, there's like 10 of them, right? In one section, and probably 10 in another section. Is there one craps table? No, there's a bunch of them. Those would be like your assets, right? So the different markets that it's trading. So the casino is doing that number 3 I talked about, where it's trading multiple strategies, games, on multiple pairs, the amount of games it has, and that way it's maximizing its edge because it knows that for every person that comes in, it's going to take X amount of money from them in general, right? So the more people that it can get coming in and the more seats that these people can play, the more money they can lose and the more money the casino can make. It's business. And as traders, we're doing the same thing, simply with the financial markets. So I hope you enjoyed the podcast episode. If you have any questions or comments, leave it below. We also had a conversation this morning as we went into back testing on like multiple time frames, and I talked about having multiple screens to make it easy. If you are someone that's interested in learning more about trading computers and what you should have or what they should include, or even if you just want to buy one, I'm going to leave a link in the description box below. If you're watching on YouTube, there's a QR code you can scan as well. It's a free trading computer builder's or buyer's guide. I've used them twice to build both of my machines. I'm very satisfied, and that's why I'm promoting them, because I've personally used them, and I only promote things that I use. So check it out. It's free. It educates you a little bit. And until next time, plan your trade, trade your plan. Hit that like button, follow, subscribe, do all the things to keep my content flushing towards your screen. And I'll see you guys next time.